Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Investing in Dividend Stocks. And today we're talking about a very particular type of dividend-paying stock. It's a group known as the Dividend Kings. We've talked about monarchs. We've talked about aristocrats. Today we're going to be talking about this category of dividend-paying companies called Dividend Kings. What are they? How is it determined that something qualifies as a dividend king? And I'm going to need your help in selecting one to be added to our example portfolio today. So a lot to cover. I'm looking very much forward to it. Before we can get to any of that, though, let me first of all say hello to everybody who's already chatting in out there in YouTube. Hello there, Jay Richardson and Prakash, Will, Simone, Life in the Fast Lane, Sharon, MZMEI, Helen, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, and I have noticed a couple of usernames out there that I don't entirely recognize, but I want to welcome you. It's great to have you on board. And if you are watching on the YouTube archive after the live stream is concluded, well, enjoy those recordings. It's a great way to watch these webcasts. But be aware that you're invited to join us in these live streams. And if you'd like to be here in our audience, this is a Thursday webcast series. We kick things off promptly at noon Eastern time. I also want to let everybody know that my very good friend Kevin Horner is hanging out in the chats in the live stream today. Kevin's going to be keeping an eye on any questions that I can't get to just during the flow of the presentation. Thanks for having my back there, Kevin. And Kevin and I have been working together now for years. So I think almost all of you know Kevin. You know that he brings a lot of experience to this discussion. Thanks for being there, Kevin. Kevin and I would also like to issue an invitation to everybody listening to follow your favorite Schwab presenters on social media. You can find Kevin and me on X. Follow Kevin there at Kevin Horner CS. You can follow me on X at Cameron May CS. As of a couple of months ago, you can also follow me on LinkedIn. Just go to linkedin.com/in and then /Cameron May CS. But let's get into this discussion about the Dividend Kings. We're going to be adding one to our example paperMoney portfolio today. But before we can do that, of course, we need to consider the risks associated with investing. These disclosures are important, so bear these things in mind. This material is intended for general informational and educational purposes only. There are risks associated with investing in dividend-paying stocks, including, but not limited to, the risk that stocks may reduce or stop paying dividends. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including loss of principal, and risks of REITs are similar to those associated with the direct ownership of real estate. All right, so with all that said, let's set an agenda for today's discussion. I am going to give a quick backdrop context. Let's look at what's going on with the markets. Now, I'm not going to look at like a typical market index. Instead, we'll look at the two charts that we've been reviewing each week that might be important for some dividend investors. Then we're going to talk about the Dividend Kings. Won't take very long to introduce the concept, but I have created a watch list of Dividend King companies. I'll be sharing that watch list with my viewers. I'll also put a link down in the video description below if you want to go get that watch list. But we're going to look at the Dividend Kings, compare those to our example priorities, and select one for our paperMoney portfolio. So a lot to cover. Let's go right to the thinkorswim desktop. Let's have a look at what's going on with the markets. And for our dividend investors, one thing that they may choose to keep an eye on is what's happening with the competition. So the competition here, let's throw up some air quotes here. What I'm talking about is, for an income-oriented investor, lots of different ways that they might choose to spread that money out. One of those things might be dividend companies. Another way to invest our funds might be to purchase, let's say, some bonds. So here's what's been going on with bonds. So the chart symbol here is TNX:CGI, and this is essentially a chart of the yield of 10-year treasuries right now. So when we see a 42.45, we just moved that decimal point one position to the left. 10-year yields are around 4.2% today, and you can see those have been climbing. Now, for a while, they held below 4.2 for a number of months. Recently, just in the last couple of weeks, we pushed up through 4.2, and maybe we might be holding at slightly elevated levels compared to where we've been over the last several months. Now, for a would-be dividend investor, the potential importance of that is that for a period of time, for right now, um, bond yields might be moderately more competitive than they previously were when weighed against, let's say, a dividend company. And that may shift some, and this is just conceptual, we don't know exactly what every investor is going to do, but maybe there's more of a commitment of funds toward bonds, maybe reducing just to a degree, who knows, a popularity of the dividend paying stocks. So where cash isn't being committed, maybe we see prices come down. And actually, that's what we've seen just going back to January 15th as yields took that spike upward. If we go look at what's happening with dividend paying companies, they've kind of come down. Now, that's not always bad for longer term oriented dividend investors. They may see a pullback as well. That can actually pop up the yields on those dividend companies and provide a short-term opportunity for new investment. Not short-term for the duration of the investment, but short-term window of opportunity where the yields might be slightly higher. So let's go have a look at what's going on with dividend-paying companies. And the chart that we use in this webcast series, not familiar to some investors out there. Let me do this. This is a nice little navigational technique. If you've looked at a chart recently, you can just click on the little down arrow here. Rather than typing in this rather long symbol, we can click on the down arrow. We can go to our recent symbols, and there it is. Let's look at the S&P 500 Dividend Monarchs Index. So these are companies, if you're not familiar with monarchs, these are companies that have increased their dividend every year for the last 50 years, and they're in the S&P 1500. So I'm going to select that. There we go. And we can see what's been happening. There's January 15th again. And if you remember, January 15th is where bond yields spiked. We've been seeing the performance, net performance of the dividend market monarchs coming down during that time frame. Now that's doesn't mean we hit the panic button. We're not traders in this discussion. This is looking at things through the lens of an investor. And a pullback like this may tend to just boost yields on average a little bit. So that might be interesting to some dividend investors. But overall, and by the way, just let me summarize again. This chart specifically isn't just a chart of the performance of dividend monarchs. It actually also assumes and builds into its performance metrics that the dividends collected are reinvested. So it's a total return showing any appreciation in price, but also dividends paid and an assumption of reinvestment over time. Right. So interesting little bit of a backdrop. It has been a bullish time for dividend stocks, as it has been for so many companies out there. Yields have been going up. I don't think that's going to be a huge surprise given that the Fed just sort of parked interest or the Fed rate for a moment. And I will say, when we're looking at a bond yield, let me go back here just a second. TNX CGI. We see this little spike here. We might have gotten a bit of a tailwind from the Fed halting rates for now, just meaning that they didn't change rates for this announcement. In any case, longer term yields like the 10-year yield, yes, they can be influenced by Fed rate activity, but traditionally they're probably seen as more influenced by expectations for stuff like inflation or economic growth. So if yields are going up, it might mean that investors are actually fairly bullish regarding the economy, regarding the inflation situation, and maybe those yields are getting a little bit stronger to try to attract investor attention. All right, so let's hit the pause button there for just a moment as we move to our discussion of Dividend Kings, because I do see something just popped into the chat window. I see that there's been a link that's been added for a survey. So we don't get this every time. So anytime you see a survey link pop in, if you're here in the live stream audience, if you do me a favor, click on that survey link and just fill the survey out when the webcast is over. It's a really short survey, just 2 questions. and then there's a comments box and a suggestion box. But if you take the time to fill out that survey, that data is sent right to me, and I read through it. I read your comments. It definitely helps. All right, thank you for doing that. But let's talk about now, what are Dividend Kings? It's actually a fairly straightforward concept. We've talked about, for example, the dividend aristocrats. With an aristocrat, number one, it has to be an S&P 500 company. Number two, it has to have a market capitalization of at least $3 billion. And then finally, this is the big deal, an aristocrat, a dividend aristocrat, is a company that has consistently raised dividends every year for the last 25 years. That's a pretty high bar. Out of all the companies out there trading in the U.S. marketplace, there are about 60 that are a dividend aristocrat. The Dividend Kings, if you think about this, an aristocrat is a high-ranking official, but not as high as a king. We're trying to raise the bar here, and instead of requiring that dividends be raised every year for the last 25 years, a Dividend King, a company to qualify for this, has to have raised dividends for at least the last 50 years. Now, so we've raised the bar in that respect, but one thing that's different, another thing that's different from aristocrats, is that it's not required for a king to be a member of the S&P 500 or a component company of the S&P 500. Another requirement that's not there is that market capitalization requirement. I will say that the vast majority of the Dividend Kings meet a $3 billion minimum market capitalization, but it's not explicitly a requirement. So there we go. So for a dividend investor, why would we care about this sort of a discussion? Well, obviously, one of the priorities of an investor might be not just to collect a dividend, but to have some faith that it might continue. Maybe they can continue collecting that dividend through the ups and downs of the markets. And these are companies that, if you think about what's happened over the last 50 years, there have been some major events. Boy, just since 2000, think about the dot-com bubble. We've had the real estate collapse, financial sector really having some rough go. And through all of that, all of these companies have raised their dividend, raised their dividend, raised their dividend. So that might give our would-be dividend investor a little bit more comfort in buying a Dividend King, that they may continue to be able to collect that dividend on an ongoing basis going forward. It takes a lot. It takes a lot of stability, a lot of corporate conviction to a concept to raise dividends every year. So where are these Dividend Kings? How can we find them? Well, I have a list here that I've compiled. Let's bring that up. So here's my watch list. Now, I've created this I've just popped this, the watch list gadget out. If you don't know how to do that, if you have a watch list over here, so here's my Dividend Kings watch list. If we need more space to add more columns to that gadget, we can click on the little menu here and select Detach Gadget. That actually pops the watch list out of the thinkorswim platform, opens it as a separate window, and it looks like this, and just gives us more real estate to start adding more columns. So where did I come up with these Dividend Kings? Well, this is how sophisticated I am. Get this. I used Google. I literally went to Google, typed in 2025. We're early in 2026. I doubt that very many services have updated a list of Dividend Kings to 2026 yet. 2025 will be serviceable for today's discussion. So I looked for list of Dividend Kings 2025. When I found that list, I looked through a couple. There are going to be a bunch of different places that provide these. Little comparison showed that, yep, they all seem to be pretty consistent. And so I just started a watch list, created a watch list, and typed in the symbols. Kelly, yeah, hey, I might work too. Yep. So I've created this watch list, which is simply typing in the symbols. It took me about 2 minutes, but to save you a little bit of time, if you don't want to do that on your own, let me share my watch list. So bear with me for just a moment. I'll grab a link here, and I'm going to pop this into the chat. There we go. Drop that into chat. And as I mentioned at the outset of this webcast, I'm also going to put this in the video description down at the bottom. So if you weren't here in the live stream, you can just go down in the description and find the link. I'll label it. It'll say something like, here's my Dividend Kings watch list, something like that. But as we go to the watch list, you'll notice that we have a series of columns, and these tie directly to the example portfolio priorities that we use in this webcast series. So if you're not familiar with those priorities, here they are. These are just examples. It's not an exhaustive list. It's not intended to be the way to invest in dividends. But for our priorities, we obviously might start with, well, the investor might be looking for stocks with an actual dividend yield, paying some dividends. Average yield right now is about 1%, a little bit more than that. A second potential priority is diversification. You know, the sectors that the dividend company is in. Third is the schedule of payments. For some investors, not always, and in this webcast series, sometimes we'll emphasize the schedule. Other times we may favor, let's say, an apparent strength of a company over, just when it happens to pay a dividend. Maybe the investor doesn't care if they get the dividend in January or February or March, as long as the dividend is being paid. But for others, they prefer a more consistent, let's say, ladder of a schedule. So that might be a priority. But consistency, which is one of those things, it's a major point of emphasis for the aristocrats, for the kings, and for the monarchs. Fifth is debt, which might be a threat to the ongoing consistency of dividend payments. Volatility. Typically, our dividend payer, our dividend or income investors prefer a smoother ride on the way to their next dividend payment rather than prices going up and down dramatically. Maybe some have an appetite for volatility. Others might prefer for that to be a little bit lower. But finally, net performance. So yes, income might be a priority, but so also might be appreciation in the investment itself, price going up over time. There we go. So those are our 7 example priorities. And what I've done here in our Dividend Kings watch list is we have this set of columns. If you need to add columns, you can just click on this little gear right here. Just select customize and just look them up. So for example, if we don't have sectors in our columns, we can just type in sector and add it. There we are, but I already have it. In any case, so one point that I want to make, I have these organized by yield. Next time, I already have in mind what I want to talk about next week. Just because a company has been increasing its dividend every year for at least the last 50 years, doesn't even necessarily mean that that dividend yield is currently particularly high. Why is that? If we look down at the bottom here, look at this. There are some Dividend Kings that are paying well under average dividends. How's that possible? Raise a dividend every year for 50 years and somehow wind up with still a very low dividend. Yes, it might be that they're making very small incremental increases, but it also could be, look at those prices. These companies may have really appreciated in price, so even incremental increases in the dividend hasn't kept the net yield ahead of that growth. It's not necessarily a bad thing to have all that price appreciation, but for a new investor with income as a priority, that's, that consistency hasn't added up to maybe, let's say, a strong investment candidate right now today. So I think these columns can be helpful as an investor might be weighing investment in one of these kings as an addition to their portfolio. So that's what we're going to be doing today. Cy Weeson says, payout ratio is important, probably more so than debt. Will allow you to know long beforehand if the company or its dividends are in trouble. That's certainly an interesting observation, and one that actually I think there are plenty of dividend investors who would agree with you. But I am going to add a little asterisk there. And today I wanted to talk about that specifically because we're going to be comparing 2 companies, one of which has a really high payout ratio. And that, for some For some investors, they might say disqualified, not interested. But I want to talk about why an investor might just take a little bit more into consideration before making that decision, okay? But let's, first of all, before we select a couple of companies from the Dividend Kings, let's go see how our portfolio is doing and what its needs might be. And then I'm going to have an example priority for today's selection. All right. So let's hide. I'm going to emphasize, let's say, a potentially new priority. So let's go to the monitor tab. Let's look at our existing positions. So right now we have $10,000 each-ish, a little bit over 10,000, a little bit under 10,000, but basically about $10,000 invested across 3 stocks so far that we've been building into in this series. $10,000 being 5% of an example $200,000 portfolio. So we've also been spreading those across a spectrum of different sectors. So for some investors who are looking for income and diversification, this is one approach that might be used. So we already own some real estate. We already own some energy. We already own some consumer staples. We have our ex-dividend date right here. We'll notice 2 of these have their next dividend scheduled for February. One of them is in January. You know, an investor might be looking for, if they're looking to ladder out those payments, maybe they're looking to add something to the portfolio for maybe March. All right. Next up, dividend frequency. Last week, we invested in a real estate company. This was a REIT. Just remember that with REITs, they have that pay through regulation, which can actually put some stress on price appreciation. But in any case, maybe one thing I wanted to point out here was that that this company pays its dividends monthly rather than quarterly. So for today, I added this dividend frequency column so we can keep an eye on that. Yield, I think our average yield right now is about 4.6% across our 3 companies. Beta is on the lower side, 0.8, 0.7, 1.1. We tally those up. We're a little bit, probably around 0.8 average, 0.9 average across the 3 companies. So lower volatility portfolio. The dividend payout ratio here. Our REIT, a little bit higher. The other 2, a little bit lower. Again, this is not unusual for a REIT. Long-term debt, all kind of around that 50 level. Now, one column that we will be keeping an eye on, because there are really just a couple of motivations for our example portfolio where we may decide to trim a position or add to a position or eliminate a position. But one of those things would be if a dividend is cut or eliminated. We'll probably remove it from the portfolio at that point. None of these have had a cut or a reduction in the dividend. Don't expect one anytime soon, but it could happen. But another thing that we're going to watch is this profit or loss percentage. We were very careful in making sure that these are all roughly equally sized for the diversification purposes of this portfolio. But as stocks move over time, that can cause an over-concentration or an under-concentration where we were careful to make sure that they were all sort of equally weighted. So we're going to allow for a strong amount of appreciation. Let's say if an individual stock goes up more than 60%, we may choose to reduce that. I know that can be counterintuitive, but in the effort of rebalancing that distribution of exposure, maybe cutting back some of the winners, and maybe even adding to some of the losers. If we see a reduction or if we see about a 20% drop in the value of a company, we may choose to add to that. In any case, there we go. Overall, though, we're up net on our positions with about a 4.6% yield, and I don't really see any reason to remove one of these or add to it just yet. So let's just add another position. So today, I said that I wanted to add a new example priority. In this case, let me drop in one more thing here. Let's look at the S&P 500. The S&P has been right up at all-time highs. It actually crossed that 7,000 point threshold for the first time in history. Do you think there might be anybody out there who's thinking, gosh, maybe stocks are a little bit overpriced at this point? Now, nobody has a perfect insight into where the markets are headed. And just because the market is at an all-time high doesn't mean it can't go to fresh all-time highs. Look at this. It's done it plenty of times in recent history. But for some, they may have, let's say, a concern about the economic phase of the markets. Could it be possible that we're in a late growth phase of the markets? Could we be at a position where stocks might pull back? That's a possibility. iShanes says, looks a little bit dodgy here. Maybe. Yeah, I'm definitely not trying to make the case that we're absolutely going down. But for some investors who are trying to balance the risk of their portfolio, at times when they think the markets seem overweighted, they may choose, as they add new positions, maybe we'll add what are called defensive positions. What are those? When an investor becomes convinced that we're in maybe a late phase of an economic cycle or a late phase of a long-term market cycle, they may move to what are called defensive sectors of the markets. And those sectors conceptually are the ones where there's just a consistent demand for the products or the services of those sectors, regardless of economic condition. When the economy is very strong and investors are feeling very confident, they may be willing to invest in, let's say, more speculative companies, more luxury brands, those kinds of things. When they are a little bit less confident about the economic situation, well, they can't decide, I don't want to buy toilet paper anymore. I guess they could. But toilet paper, food, just staples food, healthcare, yeah. Traditionally, those defensive sectors are things like utilities, got to keep the lights on. Staples, got to brush our teeth. Healthcare, got to take care of illnesses. So, how about we make that an additional point of emphasis as we're selecting a new stock for our portfolio from the Dividend Kings. So let's go have a look at those. Let's go look at the Dividend Kings. And there were a couple that I was interested in. Let's look right down here. So we have staples. We already own some staples. We have a position in staples. We have a position in real estate. And with an emphasis on this defensive positioning, how about we look at these two that are right next to each other? We have Consolidated Edison and we have AbbVie. By the way, I was talking with, isn't this the sort of conversation you have at breakfast with your wife? I was talking with my wife this morning about Consolidated Edison. True story. Just because it's one of those companies that has a name that I really like because it just sounds like one of these really old companies. I can imagine an old stock certificate that says Consolidated Edison on it. It sounds like, I always think of Consolidated this or Amalgamated that or General whatever, Associated. Those are terms that I acquaint with really kind of old companies. And interestingly, Consolidated Edison is a very old company. It's a big utilities company based really delivering services up in New Jersey and New York and Manhattan. Founded, I think, in 1823. Now, at the same time, we have AbbVie. Both of these are Dividend Kings. And let's just look across the columns here. Consolidated Edison, much smaller company, $38 billion company versus a 10 times larger company, $391 billion healthcare company. So here's our dividend investor, maybe weighing their priorities. Both of these are defensive sectors. Again, just because they're defensive doesn't mean that the markets are going to collapse and these are going to hold up better than others. That's just an economic model. That's but the basis of this discussion. Next up, the price, okay. One's $105, the other one's $221. Relative to one another, not really typically much of a consideration. It just might mean that we can buy more shares of one, or we might need to buy fewer shares of the other. Yield is fairly similar. As I mentioned earlier, average yield right now is about, well, it's a little bit more than 1%, about 1.15, 1.13% on an average S&P 500 dividend paying company. So these are up on the neighborhood of 3 times average yield. But payout ratio, who was it that said payout ratio? Somebody called out payout ratio. I wanted to talk about this today because Consolidated Edison is 58, AbbVie is 500. So what is that dividend payout ratio? Well, it's a ratio of the dividend commitment. It's not a commitment, but the dividend being paid versus the earnings over the last 12 months. So for Consolidated Edison, they paid about 59% of income from the last 12 months in dividends, 59%. All right. AbbVie, 500%. Wow. So that sounds unsustainable, doesn't it? If we have, I don't know about how your household works, but if I'm writing checks that are 5 times as big as the money that's coming in, that can be a problem. But this is a number that can be kind of exaggerated at times. It can look really, really dramatic, but just remember, let me give this some additional context. AbbVie is paying a 3% dividend. So 3% somehow manages to be 5 times as much as income. So that means our income was positive, but it just fell short of 3%. It had to be around 0.7%. What very likely has happened here is AbbVie had a large write-off. I don't know, I haven't investigated it, but there was something that caused the net income to be lower this year. Now, for a company like AbbVie that might have, it does have a fair amount of debt, not unusual for a healthcare company, with great big capital obligations. Anyway, I see that, Scott. Anyway, but the income, if we get a year where the income's a little bit narrower, a little bit lower, especially if it's lower than the earnings or than the dividend, it can cause, let's say, a one-time sort of exaggerated looking dividend payout ratio. Now, if that becomes a pattern over time, that can be a concern. But this is one of those things where the investor might just want to do a little bit more research if they're really concerned about this, or they might just say, do I think that AbbVie's going to be able to continue paying a 3% dividend like it has over the last 50 years? If they're okay with that, maybe they're still okay with the investment. So yeah, debt is, I will say, for AbbVie, lower debt, higher debt than utilities. The beta, both of them lower volatility companies. AbbVie does pay the dividend in a complementary cycle to what's already in this portfolio. We have 2 companies that are paying dividends in February. This one pays in January. So that may assist with a laddering effort in the portfolio. Now, one other thing that I wanted to point out before we make our decision, because what I'd like you to do, well, there are 2 more things that I want to talk about. Let's talk about how AbbVie is a dividend king. And you might say, well, yeah, it's a dividend king. There is something a little bit subtle that's easy to overlook there I wanted to talk about there. But I also want to look at some longer term performance charts of these companies. And then we'll make our decision. So have a look at whatever you see as potentially important in the decision here for the columns that are currently displayed. But one thing that I wanted to talk about with AbbVie is this company has only been around since 2012. What in the world? This is a list that says that these companies have paid dividends for at least 50 years, but AbbVie was incorporated in 2012. So how does it qualify as a Dividend King? Well, it actually is a spin-off from Abbott Labs. Abbott Labs were founded back in 1888, and Abbott Labs, before they spun off, including up to this moment, if we tally up the increased dividends that AbbVie has delivered since 2012, with the increasing of dividends for the years prior to that by Abbott Labs, it extends back at least 50 years. That's it. Yeah, Paul says it was a spinoff. It's exactly right. So that's one thing I want to discuss. The other thing is, let's look at the charts here. I want to look at some adjusted charts for Consolidated Edison first. Here's a 12-month chart. Let's bring up a 10-year chart, but let's adjust that. If I haven't already, I can't remember. Well, let's go to our chart settings, the little gear here, and click on equities. And yeah, we have already adjusted this for dividends. So what this does, when we select adjust for dividends and we select all rather than special or none, is this adjusts the chart to show a total return, including dividends paid. So it'll show price and then enhance that with dividends that have been paid. So let's click apply, click OK again. So this is how Consolidated Edison has performed for its shareholders over the last 10 years. It's been a pretty good 10-year run. Looks like net with price appreciation plus dividends, about 150% return. What is that? I'm going to come down here and click. Let's actually select our trend line tool. If this is helpful, this is not a guarantee of what an investor might expect over the next 10 years, but just a quick peek in the past, 172% net appreciation plus dividends. All right, so let me remove that drawing and let's flash over here to AbbVie. And what has it done? Way more. Mostly due to price appreciation. We have to be aware that that comes with, if something can go up quickly, it can come down quickly as well. But as of right now, it's been a great 10 years. So which one? What do we think? Let's make an investment. Let's add to our portfolio. We now have those charts in the back of our minds, but we have yields fairly similar. That dividend payout ratio may be an issue for some. We have a complementary payment schedule, though, from AbbVie, whereas Consolidated Edison is going to be paying in February, just like two of our other stocks. What do we think? AbbVie, much larger company. Consolidated Edison stretching a lot further back, 50 years longer. It's an 1820. This is a 203-year-old company. All right, we have 2 votes for ED. There's a third. So in this webcast series, when I cast that out for a vote, the first company to get 3 votes, that's the one we're going to invest in. So it's going to be Consolidated Edison. Let me just switch my chart back up here. Go to equities. Let me switch this back to the default, just adjusting for special dividends. Let's go back to a 1-year chart and let's go make our investment. So for Consolidated Edison, I know you guys just thought it was a cool name. It's about a $100 stock. Let's keep it easy. $100 stock, 100 shares. It's going to be about a $10,000 investment. That's right around our 5% of our $200,000 portfolio. It'll be a little bit more than that, closer to $10,500. But let's click on the ask price. Buy 100 shares, Consolidated Edison. I'm going to put this in as a market order. You might think, oh, Cameron, why don't you do a limit order? Aren't market orders dangerous? Well, yes, they carry risks. Just because this stock is showing 105.36 doesn't mean that's exactly what we're necessarily going to pay. But for an investor who's going to be in this potentially for years and years and years, does what happens with price over the next 1 or 2 or 5 seconds or whatever really make a huge difference? Probably not. So I'm going to put in a market order. Let's click confirm and send. Going to buy 100 shares of ED at the market price. There's no commission on this investment, but there can be on some types of trades. Shane says there's nothing like a diverse portfolio. I think that there are plenty of investors who might agree with that sentiment. Let me send that off and should have a pretty quick fill here. There we are, 105.39 is where we made that investment. So now we have 4 companies across a range of 4 sectors. Dividend yield, this might bring this down closer to about 4% across all 4, but still that's significantly higher than, let's say, average. And we'll just keep an eye on this portfolio going forward. But guys, we've accomplished what I set out to do today. Hope you enjoy this webcast series. I was really looking forward to doing this one where we get to focus on investing, focus on the long term. Next week, though, if you'd like to join me, we've talked about dividend aristocrats. We've talked about dividend kings. We've talked about dividend monarchs. Next week, we're going to talk about something that I call the dividend working class, something of my sort of own creation. So hopefully we'll see you then. But before I let you go, let me give you a couple of quick reminders of some other resources that are available to you, because we've accomplished what I set out to do today. We looked at the markets. We had our discussion of the Dividend Kings and invested in one of those in our example portfolio. But you need to be aware of the full slate of resources that are available to you from Schwab Education, starting with our YouTube channel. So if you're new to this, make sure that you've subscribed to our YouTube channel. You can go right down below, click on the subscribe button. It only takes a second. It doesn't cost anything. But this is where you can join our live streams. So our YouTube channel is called Trader Talks Schwab Coaching Webcasts. You can join our live streams right here. You can find our playlists of previous webcasts right here. So for example, I can click on playlists and you can see the second one right at the top is investing in dividend stocks. And you can see the 3 discussions that we've already had in this series. Now, another suggestion that Kevin and I would make for you is, we strongly suggest this, is to follow your favorite Schwab presenters on social media. You can find Kevin and me on X. You can follow us there. So you can follow Kevin on X. His handle there is @KevinHornerCS. My handle is @CameronMayCS. I'm very active on X. And when I make a post, if you reply to that post with a comment, I just try to reply right back to you. It allows for interaction when the camera's not on. So for example, I posted this question out there for my followers. Do we think that the drop in Boeing after that earnings announcement is just going to present a short-term purchase opportunity? Is that support around 240 going to hold? Or do we think this is a reversal of that longer trend there? So as they reply to me, I try to reply right back to my followers. But you can also now follow me on LinkedIn. So on LinkedIn, just go to linkedin.com/in, and then /CameronMayCS takes you right to my profile. You can give me a follow here, and I post here as well. Nice thing is I can make longer posts. But in any case, if you reply here, I just try to reply right back to you. Helen, yeah, Kevin definitely does do a great job. It's not every morning, is it, Kevin? It's like 4 times a week for you. Yeah, that discussion that kicks off our webcast day every day. Thanks. Yeah, Kevin does a great job. So join him there in the morning Trader Talks discussion. But guys, time for me to let you go. Thanks for joining me today. Thanks for all the thumbs up that I've already seen out there on YouTube. I can see over 200 people still watching the live stream, and we have 67 that have already clicked the thumbs up. That's very much appreciated. But the final thing I want to leave you with is there is a survey that's been added to the chat window. Kevin's reposted it a couple of times. Thanks for doing that, Kevin. But if you'll just click that survey link now, give me some honest feedback. Just two quick questions, a comments box and a suggestion box. I definitely read through that data and definitely read through the comments. It always helps. All right, everybody. Thanks for joining me today. I will look for you at a future webcast. I'll also look for you on social media, on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy investing. Bye-bye.